students, this is the second part of today's lecture. I stopped here in the previous lecture. So just to refresh your memory, journal is the first book in accounting, and you have to record business transaction in journal in step 2 of the accounting cycle. So there are many types of journals, but in this course you will learn about how to record business transaction in general journal only. So this is the format of a general journal entry. First, see here in the yellow box, you have to write the date, and then you have to show the debit entry and the amount. The XX is supposed to be the amount, and then the second thing is you have to show the credit entry. What is the account that you will credit, and then you show the amount. And the last thing in this general journal entry is you have to write explanation. Okay, let's see several examples. Okay, see here. Let's say you are doing accounting record for a business, and then like I said earlier, when you do the accounting record, you have to follow the accounting cycle. The first step in the cycle is analysis. So the analysis happen after a business do a transaction. So this is the transaction. An example of a transaction. Supplies purchased for $250 are purchased on account. On account means the business purchase supplies today, but the business will pay later in the future. So the question asks you to prepare the correct journal entry. So what to do? So to do this journal entry, first you have to do the analysis, the step 1 of the accounting cycle. Then after that you can do the journal entry or the second step. So now analyze this thing. Supplies purchased for $250 in account or on account. So you analyze first. After this transaction happen, you analyze. Analyze means you have to know the type of the transaction. So the type of the transaction is supplies purchase on account. That is the type of the transaction. And then you have to know the effect of the transaction on the accounting equation. So what will happen to asset? So the accounting equation is asset equal to liability plus equity. So what happened when this business purchase supplies $250 in credit? So the thing that will happen is when the business purchase supplies $250 in credit, the thing that happened to asset is asset supplies increase. So you can imagine there is a business. When the business purchase the supplies, the supplier send the supplies to the business. So supplies goes in. When supplies goes in, asset supplies increase. The amount is $250. That is the first effect. And then what is the effect on liability? The effect is liability increased $250. Why liability increased $250? Because the business purchased on credit. The business will have to pay $250 in the future. So it is like the business owe money to the supplier. So in accounting, when a business owe money to the supplier, you have to record it in account payable. There is the effect on liability, and there is no effect on equity. So the effect of this transaction is asset. The name of the asset is supplies increase. The second effect is liability, which is the account payable, also increase. The amount is $250. So how to record that in general journal? So to record that in the general journal, you have to remember the rule of debit and credit. The rule says, if asset increase, you have to debit. Asset decrease, you credit. Okay, and then so remember the first effect of this transaction on asset is asset supplies increase. So January 1st, assume that the transaction is on the 1st of January. Asset supplies increase, so you debit account supplies, the amount is 250. The second effect of this transaction on the accounting equation is liability increase. The rule of debit and credit says when liability increase, you have to credit the account. So that's why you see here in the general journal entry, you have to credit account payable, which is the liability. The amount is 250. So the explanation is purchase supplies on account. Okay, let's see example 2. A check for $1,000 is received in payment for services rendered. Make the correct journal entry. Okay, let's see. We will do this. The situation is like this. The business is a service business. And one day, the business has provided services to a customer and then received $1,000 in cash. That is the transaction. So, you know that before you can do the journal entry, you have to do the step 1, which is the analysis. So, you know this transaction. And then, what is the effect of this transaction on asset, liability, and equity, which is the accounting equation. So first, when the business received $1,000 check for payment of service, the first thing that happened is the effect of this transaction on asset is asset cash increase. Asset increases, the name of the asset is cash, because the business, imagine there is a business, one day the business received cash $1,000 or check $1,000, so check is cash. So asset increases, the name of the asset is cash. What is the effect of this transaction on liability? There is no effect on liability, zero effect, because the business does not borrow anything from anybody. Okay, but look at the equity. Remember, equity, honest equity, is related to 4 accounts. Honest equity is related to 4 accounts. First, it is capital, and then borrowing, and then revenue, and then expenses. So this transaction is about revenue. Revenue increases because the business received $1,000 after providing services. So the effect of this on equity is there is an increase in equity because there is an increase in revenue by $1,000. There is an increase in equity. The account is revenue account. The amount is $1,000. So how to do the journal entry? Okay, remember the first effect is asset increase $1,000. The name of the account is account cash. So asset increase, debit or credit? Asset increase, you have to debit. So the journal entry is, assume that the transaction here is on the 1st of February. So asset cash increase. Cash increase, remember the rule of debit and credit, you have to debit. So debit account cash 1,000. And then remember, equity increase, you have to credit. So the name of the account related to the equity is revenue. So credit account service revenue 1,000. The explanation for the transaction is receive cash for services. Maybe it is difficult for you if you see this for the first time, but I will show many examples, and later hopefully after seeing many examples and do readings and exercise, you will understand how to do the journal entry. Okay, let's see. Provide services to a customer, and then on account for $750. So the situation is like this. This business provides services to a customer, but the customer will pay later in the future. So how to do the journal entry? So first step, you have to know the effect of this transaction on accounting equation. So this transaction, the effect of this transaction on asset. So the effect is asset will increase. When the business provides services in credit, it means that the customer will pay the business in the future. So in accounting, if an item benefit the business in the future, it is supposed to be recorded as an asset. So in this situation, asset increase, the name of the asset is account receivable. In accounting, if you have a business, your customer will pay something in the future, you record in account receivable. So asset increase, the name of the account is account receivable, the amount is $750. And then what is the effect of this transaction on liability? There is no liability because the business does not owe anybody. The customer owe the business, but the business does not owe anybody. So there is no effect on liability of the business. But there is an effect on the equity. Like I said earlier, the equity is related to 4 accounts: capital, withdrawal, revenue, and expenses. This transaction is related to revenue. So the capital will increase, the account is account revenue, the amount is $750. So the journal entry is, you have to write the date, and then remember the first effect, asset increase. The name of the account is account receivable. So asset increase, you have to debit account receivable, the amount is $750. The second effect of the transaction on accounting equation is equity increase. Okay, remember, when equity increase, you have to credit the account. So the related account in this situation is revenue. So credit account service revenue $750. The explanation for this is provide services on account. So this is how the general journal looks like. The general journal is like a book. So this is the way to record that. To record the 3 sample transactions that I have explained in the previous slide. See here, the record is in chronological order. It is according to the time it happened. The transaction on 1st of January will appear first, and after that transaction on 1st of February, and after that transaction on March. Okay, we do several more. Let's say in 1st of November, business ABX pays water and electricity bills for $110. So what is the general journal entry for this? So when you want to do this, remember, you have to do the step 1 of the accounting cycle. What is the effect of this transaction on accounting equation? When the business pay, the effect on asset is asset cash decrease 410, and then there is no effect on liability, but the equity will decrease. The equity will decrease. The related account is expenses. When a business make an expense, and the equity will decrease. Okay, so asset decrease, equity decrease. So how to do the general journal entry? First you have to write the date, and then after that asset decrease, so you have to credit asset decrease. So credit account cash 410, and then equity decrease. Equity decrease, you refer to the rule of debit and credit. Equity decrease, you have to debit. So debit utilities account, debit utilities expense account. The amount is 410. In accounting, when a business pays bills like electricity, water, internet, we record this in an account called utilities account. Okay, see the second example. 3rd of November, the business borrows $10,000 from a bank. What do you think? So the effect of this transaction is asset increase. The name of the asset is the name of the asset is cash. When a business borrow money from a bank, the bank will cash goes into the business. Imagine a business borrow money from a bank, the business will receive cash from the bank. So asset cash increase 10,000, but in the on the liabilities, the liability will increase because the business has made a bank loan. So the business borrow something from bank, so liability increase. So the effect of this transaction is asset, the name of the asset is cash, increase 10,000. The second effect is liability, the name of the liability is bank loan, increase 10,000. So how to record that in the general journal? You have to write the date, and then asset increase, you debit. So debit account cash 10,000, and then liability increase, you credit. So credit account bank loan 10,000. On the 10th of November, the third situation here is 10th of November, the business purchases an equipment 1,200. So what will happen? You have to analyze first what is the effect of this on asset. When the business purchases an equipment, the first thing that will happen is cash goes out. The business has to pay. Cash goes out. Asset cash goes out. The asset cash decrease 1,200. The second effect is the business receive the equipment. So the second effect is asset equipment increase 1,200. So there are two effects on asset. Asset cash decrease 1,200. The second effect is asset equipment increase 1,200. So how to record that in general journal? You write the date 10th of November, and then debit account equipment, because asset increase you debit account equipment 1,200, and then you credit account cash 1,200. Why credit account cash? Because cash decrease. When cash decreases, when asset decreases, you credit. Okay, that's all for today lecture. Do not forget to write your name and matric number in the comment section.